What you just witnessed was not a collapse. It was a calculated demolition. A 13% single-day crash in silver. From $87 down to $76, the kind of headline that sparks panic and clears out portfolios. It's the worst drop since the COVID crash, and it came on the back of a shockingly strong jobs report, a soaring dollar, and a hawkish new Federal Reserve. To the untrained eye, this looks like the end of the silver thesis, but you are not untrained. What if I told you this bloodbath was the final, necessary purge, the exact signal we've been waiting for that screams it's time to buy? This is the story of how the paper market is dying and the physical reality is about to enforce its law. This is the story of the greatest disconnect in modern financial history, and the historic opportunity it creates for those who can see past the panic. Let's start with the immediate trigger, the economic shockwave. The February non-farm payrolls report was a monster, showing 89,000 new jobs when only 50,000 were expected. Silver decoupled violently. Its crash was magnified by a secondary structural attack, the CME exchange, the heart of the paper silver market. Jacked up margin requirements on futures contracts by over 50% overnight. This was a mechanical, deliberate purge. It forced smaller, leveraged speculators to sell at any price. The result was an algorithmic avalanche: 35 million ounces of worthless paper contracts dumped in 2 hours of pure, unadulterated panic. This wasn't organic selling. This was the system liquidating its own weakest links. But here is the single most important fact, the one that changes everything. While the paper price on your screen plummeted to $76, the price to actually buy and take delivery of a physical, tangible kilo bar of silver did not crash. It held at $142. Let me say that again. The spot price is a fantasy of digits and leverage. The physical price is the reality of metal you can hold. In Pakistan, the premium for real silver has exploded to a 55% markup. This is the great disconnect, and it is being driven by one unstoppable force: industrial necessity. The global green energy transition is not slowing down, it is accelerating. Solar panel manufacturing will consume over 260 million ounces of silver this year. Electric vehicle batteries need millions more. There is no mass market substitute. Tesla alone could need over 60 million ounces annually. These factories operate on just-time inventories. They do not have stockpiles. The silver stops, their multi-billion-dollar production lines stop within weeks. They are not bidding on a paper futures contract. They are bidding for a physical survival input, and they will pay what the market demands to get it. This creates an unbreakable price floor that no Fed policy or jobs report can shatter. Now, look at the system supporting that paper price. It is a house of cards built on promises it cannot keep. The COMEX, our primary trading hub, now reports a staggering 7.1 paper claims for every single ounce of registered deliverable silver in its vaults. This is not a stable ratio. It is a countdown to failure. Projections for February delivery demand threaten to claim 127% of the available metal. This is a mathematical impossibility. When the music stops, there are only two outcomes: a wave of cash settlements that destroys trust in the entire paper contract system, or a violent, explosive repricing where the paper spot price is forced to rocket upward to meet the undeniable reality of the physical price. This engineered crash is the final act of the paper market's theater, flushing out the last speculators before the physical truth takes over. History is screaming at us that this is a generational buying signal. Look at the precedents. In 2011, silver was crushed by 47%, only to rocket to new highs months later. In 2008, it was hammered down 55% before beginning the legendary bull run that took it to $49. These violent shakeouts are not the end. They are the painful, necessary reset that clears the path for the next leg up. The current setup is even more powerful because the demand is no longer speculative. It is structural, embedded in the very infrastructure of our new energy and technological future. Meanwhile, supply is being strangled. New tariffs are permanently diverting millions of ounces from Mexico and Canada. Mine supply is stagnant for the next decade. The annual deficit between what the world needs and what it can produce is measured in hundreds of millions of ounces. So what is your move? Your strategy must be built. Your strategy must be built on the physical truth, not the paper illusion. Your absolute, non-negotiable priority must be acquiring physical silver. This means taking direct possession through American Silver Eagles, Canadian Maple Leafs, or 1-ounce rounds from the most reputable dealers. This is not a trade. This is the acquisition of a tangible, industrial commodity. You must avoid the paper ETFs. They are bets on the very system facing a crisis. For leveraged exposure, consider the domestic mining companies. Firms like Hecla and Core Mining are no longer just stocks. In an era of reshoring and supply chain nationalism, they are becoming strategic domestic assets. We stand at the precipice of a historic regime change. The volatility you see is the death rattle of an over-leveraged paper system that no longer reflects reality. The floor beneath the market is not set by traders in New York. It is set by factory managers in Michigan and Nevada who need this metal to keep the lights on and the production lines moving. They have already locked in their contracts for the year at prices far above the current paper spot. The $76 price is a mirage. The $142 price is reality. Your task is not to panic at the engineered crash. Your task is to recognize it as the final, greatest opportunity, the last chance to position yourself on the right side of the great divorce before the paper market concedes to physical reality and the price resets for a new era. The time for hesitation is over. The signal is clear. This is the capitulation. Now is the time to stack.